Hi everyone. So welcome you all to the chapter 7, that is pricing decisions chapter of this management accounting lecture series. So this pricing decisions lesson is quite short but a very important topic in our syllabus, right? So organizations need to have that understanding how to make pricing decisions in their organizations. So we'll see how the pricing decisions can be made, what is the importance, what are the types of pricing decisions, and everything during this discussion. And you might be wondering, now this is a management accounting lecture, right? In this lecture, that talks about cost and everything, why are we talking about pricing decisions? So you will get an answer for that question as well. Why pricing decisions are discussed in this lecture series, right? So we'll go to the session objectives first. So in this session, we are going to uh, address these session objectives. So at the end of this session, after completing this session, you should be able to identify the major factors influencing the pricing decisions in an organization and explain the relevance of economist pricing model in pricing. We'll discuss that as well, and justify why cost plus pricing is widely used. That is one method of pricing. So we'll discuss cost plus pricing, and then what are the limitations of that, and explain the use of target costing. And that is another concept, target costing. And finally, identify and describe the different introductory pricing policies. So this is the outline for today's lecture. These are the session objectives we are going to achieve at the end of this session. Right. Okay. So before moving on, there's one table, right? Since this is an online lecture, you can, while listening to this recording, you can answer to this question. So my question is, what are the major factors influencing the pricing decisions of an organization? There are different factors, many factors affecting the pricing decisions of an organization. So I told you organizations need to make pricing decisions, right? Pricing decisions. Now, but you will get to know about those different kinds of decisions, but generally pricing decisions before setting a price. Now, sometimes your company has introduced a new product to the market. They are also, before starting the sales, you need to decide a pricing decision. Sometimes it's an old product, you are continuing to sell that product, but with different factors, you need to decide the price of that product again. Maybe you need to revise it. That is also a pricing decision, right? So any kind of pricing decision, what are the factors affecting? So think about the factors affecting and try to fill this table, and I'll continue with the discussion. Now, when it comes to these factors, majorly there are two major factor categories: internal factors and external factors. Internal factors are affecting the decision, external factors from the external environment. Those factors affect our pricing decisions. So we'll see what are those, right? Internal factors. The first one coming under internal factors is cost. When you are making a pricing decision, when you are deciding a price for your product, cost is very important. That is one of the major factors affecting the pricing. ඔයාලා pricing decision එකක් ගන්නකොට cost එක පිළිවෙල තාමත් වැදගත් කාරණාවක් වෙනවා. Second factor, organizational goals. Now think about organizational goals. Now sometimes companies are trying to maximize the profits. They are trying to maximize their profits. Some companies, they want to increase the market share. Likewise, there are different organizational goals. Now, if a company wants to maximize the profits, right? If that is their goal, that is the objective, then what should be the pricing decisions? Pricing decision also, that is a decision, right? That decision should be linked with your organizational goals, right? If you are trying to maximize the profits, maybe you will have to increase the prices. Why? To increase the revenue. Or else maybe you need to decrease the prices. Why? While decreasing the price. When you decrease the price, you can sell more quantity. You can sell more units. Likewise, we don't know the nature of the product, but with your organizational goal, you will have to take pricing decisions, right? If you want to increase the market share, if that is your organizational goal, maybe you will have to decrease the price. By reducing the price, you can you expand your market share. Likewise, there can be situations. So depending on the organizational goal, depending on other factors, pricing decisions can be taken. Organizational factors. What are the factors in organization? When it comes to employees, when it comes to your costs, different organizational factors can be there. Again, they are affecting the pricing decisions. Distribution channel. Let's say how you are going to distribute your products to the customers. Sometimes there's direct distribution. What do you mean by direct distribution? Manufacturers directly distribute the products to customers. Direct distribution. In that direct distribution, do you have intermediary parties? Like, do you have retailers, wholesalers, and everyone? No, right? Direct distribution. So, in that case, maybe your price can be low because there are no profit margins kept by intermediary parties. You can directly give it to the customer. And if you have indirect distribution, that means you have retailers, wholesalers in between the manufacturer and the end consumer. Then the prices can be high. Likewise, pricing decisions can be changed based on the distribution channel. And pricing objectives. What is the objective of the pricing? To maximize the price again, or to have cater to a larger market, a big market. Likewise, pricing objectives can be there. Product characteristics. If you take a product, what are the features? If you have special features, if the pattern is unique, and there are so many it's a good design. So product characteristics can be there. Based on the characteristics, based on the specialty, pricing can be changed. If there are so many unique product characteristics, there may be a high price. You can charge a high price. Likewise, product differentiation. Again, it's similar to product characteristics. Product differentiation means how are you going to differentiate your product with other competitor products. Let's say there are two products, product A and product B. Your product both are similar products, but product A is different to product B, even though it serves the same purpose. එකම දෙයක් වෙනුවෙන් පාවිච්චි කරත් product A එක වෙනස්. ඇයි? Maybe high quality compared to product B. Product A is high quality, or maybe packaging is very unique. It has a very unique design. So what? You can charge a higher price. You can charge a higher price because of that differentiation. Likewise, there can be situations pricing decisions are affected by those internal factors. Right. So all these are internal to the organization. What are the external factors? There are external factors affecting the pricing decisions. Maybe competition. When the competition is very tough in the market, there's intense competition in the market, can you increase your prices as you want? No. Maybe you will have to see the market price. What is the competition? If I want to compete in the market, if you want to survive in the market, survive in on market, okay? Maybe you will have to reduce prices, adjust the prices, likewise, right? Competition is important. Price elasticity of demand, right? Price elasticity. When the price is changed by 10%, what is the impact on the quantity demand? මිල වෙනස් වෙනකොට මිල වෙනස් වෙන ප්‍රතිශතයට කොච්චරක් quantity එක ඉල්ලුම කොච්චරක් වෙනස් වෙනවද? You have learned this in economics if you have done economics, right? So price elasticity of demand. Some products are elastic, some products are inelastic, right? Likewise, there are different categories when it comes to price elasticity. So you need to know the price elasticity of your product, whether this is a very essential product. Let's say pharmaceutical products, drugs. When it comes to pharmaceutical products, essential drugs, right? Essential medicine, when you increase the prices, will there be a major effect on the quantity demand? Price එක වැඩි කරා කියලා quantity එක එන්න එන්න අඩු වෙලා ලොකු අඩුවක් පෙනෙයිද? What do you think? Will there be a major effect, major impact on the quantity? No. Why? Price elasticity, inelastic. Inelastic price elasticity. Even though you change the prices, there won't be a major impact on the quantity. Why? It is an essential thing. Even though the prices are higher, people will still buy because those are essential medicine items. So likewise, pricing decisions will be changed based on the price elasticity of your product. Maybe competitors' pricing policy, very important. You are competing in the market with competitors. If you are not in a monopoly, ඒකාධිකාරයක් නොවේ නම්, if you are not in a monopoly, you have competitors, right? When you have competitors, you have to see what is the price of my competitor. Likewise, you will have to adjust. So your competitor is selling the same product at 100 rupees in the market, but the same product you have, you are trying to sell it at 300 rupees. There's a huge price gap, so that won't work in the market. That's why you need to see competitors' prices as well. And then suppliers' raw materials. You have to see the raw material cost, right? Suppliers' raw materials. Economic conditions. What is the interest rate? What is the inflation? Exchange rates in the economic environment. Those things will affect your pricing decisions. If the inflation is very high, all other materials cost will go up, then you will have to increase your prices as well. So economic conditions are important. And then the consumers and businesses, customers' perceptions, their requests, and legal and regulatory issues. The government will enforce different laws, maybe maximum prices, and then maybe laws and regulations for the selling. Likewise, different legal backgrounds will be there. So based on that, you will have to change your prices. Let's say the government is putting a maximum price. Maximum price එක මෙන්න මේකයි කියලා government එක කියනවා. Now can you exceed that price? No, actually, right? Practically you can't. So in that case, you will have to change your prices. Or that is the maximum price you can sell your product in the market. Likewise, different factors, internal, external, different factors are influencing your pricing decisions in an organization. Right, so I hope these factors are clear now. Now it says here, look at this point. Empirical studies have found that cost-based pricing remains dominant in pricing practice. Now, out of the all factors we discussed, what is the dominant factor? Cost-based pricing. Cost is very important. You have to consider these factors. You have to consider these other factors. But cost is also very important. Cost is the dominant one. A study has, a research has done, and that research has found it. Right? Okay, remember that one as well. Cost is important. And this is the second session objective of this session. Now here it says the economist pricing model. Now let's talk about the economic side of this pricing before moving on to management accounting. Now, when we are deciding the prices, if you have learned economics, right? So here, a theoretical solution is given by the economics. Now, read this. The theoretical solution to pricing decisions is derived from economic theory, which explains how the optimum selling price is determined. Now, when it comes to economic side, economics are giving a solution for these prices, how the prices are decided. Now, as per the economist model, as a theoretical solution, they say the optimal price where the profits are maximized. Profit එක maximize වෙන optimal price එක. උපරිම price is determined by intersection of the marginal revenue and marginal cost curves. Marginal revenue, where the marginal revenue and marginal cost equal, that is the point where the optimal price we can find. Look at this graph, then it would be very clear to you. Right. Look at this, the bottom graph first, the second one. This is the first one, this is the second one. Here, you can see marginal revenue curve. Marginal revenue means ආන්තික ආදායම. Marginal cost, ආන්තික පිරිවැය. Right. Marginal cost and marginal revenue curves are there. What is this point? MC equals MR, marginal cost equals MR, marginal revenue. Now what happens? At this point, where marginal cost and marginal revenue curves intersect, when you go up here, this is the optimal price, where the marginal revenue and marginal cost equal. When you see the price, at which price marginal revenue and marginal cost getting equal, that price is the optimum selling price, optimal selling price, right? That is the optimal price. At that price, when you are selling at maybe 34 rupees, optimal price, you can maximize the profits. That is the solution given by economics model. See, now the price is this. When you go up, you can see in the first graph, total cost and total revenue curves are drawn based on that price. See, highest profit, maximized profit is achieved at the price of 34. That is the optimal price. So this is the explanation given by this. So the optimal price is always where the marginal revenue and marginal cost is equal. That price is the optimal price. There you can maximize the profits, right? So this is the theoretical solution given by economics, right? Remember that one as well. Now we are talking about the problems. Now you understood what is the meaning of economics theory for pricing. Now we are discussing what are the problems, what are the limitations of this theory. Demand is influenced by other factors besides price. What is that? Now, apart from the prices, demand is influenced by other factors as well. In economics theory, it only focuses on the price. But demand is influenced. ඉල්ලුම වෙනස් වෙනවා වෙනත් කාරණාවන් මතත්. Demand is influenced by other factors as well. So that is one limitation, one problem. Difficult and costly to derive reasonably accurate estimates of demand. So you have to estimate the demands when you are making that computation, when making that calculation. So it's difficult and costly to estimate the demand. That is another problem. Third one, difficult to estimate cost functions to determine marginal cost at different output levels for many different products. If you have different products, it's very difficult to estimate the cost functions of each and every product. That is another problem. Profit maximization is assumed. Firms may pursue other goals. In this economics theory, it thinks like it assumes that profit maximization is the goal of the organization. But in reality, there can be different other goals as well, not only the profit maximization. So here, profit maximization is the goal. To maximize the profit, what is the optimal price? That was decided through MC and MR. But I'm saying, There are problems with the economics theory. Apart from profit maximization, there can be other goals as well. So these are the common problems we face coming with economist theory, right? So you understood the economic theory, and then what are the limitations, problems. Because of this, we are giving solutions in management accounting. Because of these issues in economics theory, we have to discuss about these pricings in management accounting as well. That is the approach we can take. Right. Okay. Now we have to understand why pricing decisions are based on cost information. Now, the answer for your question, if you were wondering why are we discussing pricing decisions in this management accounting lecture, we are going to discuss the relationship now. How cost information and pricing decisions are getting linked. So now you have an understanding when the pricing decisions are taken, when we are deciding the price, cost is very important. Cost is a dominant factor. So cost information and pricing decisions. What is the relationship? Before that, you need to know two parties in this economy. Two parties. Price takers and price setters. Price takers and price setters. Who is a price taker first of all? Firms that have little or no influence over the prices of their products or services. In this economy, in this market, some organizations, they can't make their own prices, they can't decide their own prices, they are taking the price takers are there. They have little or no influence over the pricing. Price takers. When now there are two instances, as you can see, Roman number 1 and 2, there are two instances where there can be price takers. When there are many firms in the industry and there is little to distinguish their products from each other, there are so many competitors, there are so many firms in the market, and there is little to distinguish their products. All products are similar, no differentiation. Prices are set by overall market supply and demand forces. Now, when there are so many firms and there are no differentiation between the products, then those firms do not have the power to influence the price. That is one price. One price is prevailing in the market. All firms are taking that already decided price. How that one price is determined? Prices are set by overall market supply and demand forces. ඉල්ලුම හා සැපයුම අනුව price එක decide වෙනවා. That decided price will be taken by the all firms in the market. So no one firm is deciding the price. All firms are taking the already decided price based on the market supply and demand forces, right? They don't decide. So firms in commodity market selling wheat, rice, sugar, all are having the same prices, right? Or there can be another situation. Or small firms operating in an industry where prices are set by the dominant market leaders. Dominant market leaders are there in that market, but small firms are also there. Who is deciding the price? Who is having more influence over the price? Those dominant market leaders. Dominant market leaders are deciding the price. That price will have to be taken by the small firms. So those are the two situations where price takers are there. Price takers are not deciding the price of the product. They are taking the price in the market. They are taking the price in the market. Right, remember that. And the second one is price setters, opposite of price takers. Price taker didn't make the price, but price setter is setting the price. Price setter. Firms that have some discretion over setting the selling price of their products or services. They have some discretion. What are the two instances again? Selling products or services that are highly customized or differentiated from one another by special features. Selling products and services which are highly customized. Differentiated products. If you are selling a differentiated product, now you have some discretion over the price. If it is a very unique product in the market, you can increase the price or you can decide the price, right? Or who are market leaders, or else you are the market leader. When you are the market leader, you have some discretion over the prices. You will be setting the price in the market. So those are the two instances price setters can be there, remember. Okay, now the most important part. Now, for both price setters and price takers, cost information is important. Now, I told you price takers are not making pricing decisions, but price setters are taking pricing decisions. Now, then why cost information is important? Now, this is cost information. Why cost information is important? For price setters, people who are making prices, setting prices to make their prices. For pricing decisions, they need cost information. එයාලගේ pricing decisions ගන්න cost information ඕනේ. Why we discussed that cost is one dominant factor affecting prices. So for pricing decisions, cost information is important. I hope that's clear, right? Why price takers now? That's a problem. Now, price takers are not setting prices as well. Then why cost information? That is for another purpose. Cost information is important for price takers for another purpose. In deciding on the output and the mix of our products, and services to which their marketing effort should be directed, giving more emphasis on the prevailing market price. They are not making or setting prices, but they want to decide how many units I'm going to sell. What should be the production? How many products I need to manufacture to sell, right? That decision should be taken. Or else, when there are multiple products, A, B, and C, from product A, how many units I need to produce and sell? From product B, how many units I need to sell? Product C, how many units I need to produce and sell? Basically, mix of products. Product A, how many units? Product B, how many units? Product C, how many units? Mix of products. So to take that decision, cost information is important. But they are not setting prices. They are taking the prevailing market price, right? So they have to decide at the prevailing market price. Market එකේ තියෙන price එකට කොච්චරක් අපිට විකුණන්න පුළුවන්ද? කොච්චරක් අපිට හදලා විකුණන්න පුළුවන්ද? At the prevailing market price, what is the output we can produce and sell? Or else, at the prevailing market price, what is the mix of products we need to produce? How many units from product A? How many units from product B? Likewise, what is the mix? You call it product mix. What is the mix? So to take that decision, you need cost information. Right. So those are two different scenarios, right? For price setters, directly to for pricing decisions, cost information is important. But for price takers, not for pricing decisions, because already the price is decided. To decide decisions on output and the mix of products. කොච්චරක් හදනවද? or එක products වලින් කොච්චර හදනවද? To make that decision, cost information is important. So remember why the importance. Right. Moving on to the next subtopic. Now you are talking about cost plus pricing. This is one particular way of pricing a product. Cost plus pricing. So when you read those words, you can get some kind of understanding, right? Cost plus pricing. You take the cost as the base, you add something, you add a markup, and then you decide the price. Cost plus pricing. Many companies use product cost as an input to establish selling price. So to take the pricing decision, you take the cost as the base. Product costs are calculated. You have to calculate the cost first. If you don't have the cost, you can't use cost plus pricing, right? You calculate the cost first, and a desired profit margin is added You add a markup to determine the selling price. This approach is called cost plus pricing. You add a markup to the cost. Now here different approaches to cost plus pricing is there. There are different approaches. Actually, this is a mathematical. They are based on the mathematical differences. There are different approaches, right? You will understand that. Now here, let's say these are the cost items, cost elements coming under total cost. What are those? You have direct variable cost. You have direct fixed cost. And then you can take total direct cost, which is prime cost. And then you add indirect overhead cost. And then you take the total cost. This one you already know. We have discussed. Direct variable, direct fixed, and then total direct. After that, you add the indirect cost. Now, let's say of our product, we have one product. Direct variable cost of our product is 200 rupees. Direct variable cost, maybe direct material, direct labor, everything, 200. That is the price. That is the cost. Here, we are adding 150% markup for the direct variable cost. Then what is the markup in rupees? Markup means our required desired profit margin. 200 multiplied by 150% equals to 300 rupees. That is our markup. That is profit. Then what is the price? If the cost is 200, if you are adding 300 rupees to the cost, then you have a price of 500 rupees. What do you call this approach? You call it variable cost plus pricing. Variable cost plus pricing. Why? You took only the direct variable cost in as your cost base. You took only direct variable cost as the cost base. So you take that one and then you added a margin or the markup and then you have the price. Right. Okay. Now we have 200 direct variable and you add direct fixed cost rupees 100 and then you have the total direct cost 300 rupees. Okay, for this, based on this one as well, we can decide our price. How can we do that? Our cost is 300, that is total direct cost, only the total direct cost. And then you can add a 70% margin markup. And then the markup in rupees is 210 rupees. When you add 210 to 300 rupees, you have a price of 510. What is that? Cost plus pricing. Which cost? Direct cost. So we took only the total direct cost. So you call it direct cost plus pricing. Why? In addition to direct variable cost, you have considered direct fixed cost as well. So you have the total direct cost. You add some markup to that total direct cost. You have the direct cost plus pricing. Going forward, you add indirect overhead as well. Now you have the indirect overhead cost as well. Then that is total cost. 380. You had 300 total direct cost. You add your indirect, that means overhead cost 80 rupees to 300. Then you have 380 rupees. What is your markup? 35% markup is added. Then the markup in rupees is 133 rupees. Then you have the cost plus pricing 380 plus 133, 513. What do you call this approach? Then you call full because you have taken the full cost. Full, or you say long run cost plus pricing. Full cost plus pricing or long run cost plus pricing. These are the different approaches you can take. So all these are mathematical approaches. Based on the mathematical computation, you have different approach. But the theory, the style is the same. The way you compute the price is the same. Only difference is the taken cost base, the selected cost base. So this would be very clear with this. Look at the first one, variable cost plus pricing. What is the cost base? Cost base is direct variable cost. You only know the direct variable cost. Now, what do you have? What are the unknown things? You have not added direct fixed cost. You have not added indirect overhead cost. And in addition to that, you need to have a profit as well, no? Before deciding the prices, before adding a markup, you need to have a profit as well. So net profit, right? Net profit also there. So you have only the direct variable cost, that price, that cost you know, but you don't know these three things: direct, fixed, indirect overhead, and net profit. So you need to cover all these elements when setting the price, right? When setting the price, you need to cover all these three elements. So you are adding a higher markup, 150%. That's why you added 200, that is your direct variable cost. You have so many other costs coming. So you added 150% markup. Then you decide the selling price. Look at the direct cost pricing. That means you know the direct variable cost and you know the direct fixed cost as well. So your cost base is now expanded. You know direct variable plus direct fixed cost. Now you have to cater only to two elements. You don't know indirect overhead and you have to add something for net profit as well. So you can add a 70% margin markup. So it's not 150%. Previously you had to cover three elements. So you added a higher markup. But now only indirect overhead and net profit only. Maybe you can reduce the markup, that is 70%, only for two unknown factors. Then you can add this, you can get the selling price. Look at the final one, full cost pricing. There you know the full cost of the product. No problems, you know the full cost. You know the direct variable cost, you know direct fixed cost, you know indirect overhead. So cost base is very expanded now. It's expanded. Now you need to cater only to the net profit. You need to worry about the net profit only. So you had a very small markup, 35%, right? Compared to these markups, a smaller markup, 35%, then you can get the selling price. So markup from 150% to 35%, it got reduced. Why? You got more and more information when it comes to full cost pricing. You get to know about the cost basis. So it's all about the traceability of cost. It's all about the traceability of cost. In some organizations, it's very difficult to get the full cost. It's very practically, it's difficult to get the full cost of the product. But you can easily take the variable cost of the product. You can easily get the variable cost of the product. So you have only this one. So you add a higher markup. Then you easily decide the selling price. But in some organization, you can trace direct variable as well as direct fixed cost. Then you can add a comparatively a lower markup and decide the selling price. So it's all about the traceability. If you can trace more and more cost elements, you can add a lower markup that is only sufficient for the net profit and decide the selling price. If you don't know, if you can't trace many cost items, you can take only the direct variable cost and add a higher markup and decide the selling price. So these are all mathematical things, right? Based on the traceability of cost, you can decide. All these are cost plus pricing. Even though there are different names, all these are cost plus pricing methods. Right. So it says different points. Markups are related to the demand for a product. A higher markup can be added for a high demand product. Likewise, when the demand is changed, your added markup will be changed. When there is high demand for the product, maybe you can increase the markup or decrease the markup to protect the demand. Likewise, you can decide. Markups are also likely to decrease when competition is intensive. If the competition in the market is very intensive, you won't be able to add a higher markup and increase the price. Maybe you will have to decrease the markup. So based on the competition, your added markup will be changed. Target markup percentages tend to vary from product line to product line. If you have multiple product lines, markup will not be the same for all product lines. That will be different, right? Correspond with well-established differences in custom, competitive position, and likely demand. So, read this example. Luxury goods with a low sales turnover may attract high profit margins, whereas Non-luxury goods with a high sales turnover may attract low profit margins. If it is a luxury product, even though there is low sales turnover, your prices are very high, your markups are very high. But non-luxury goods, but a huge quantity is there, maybe you added a small markup. So there can be differences, product line to product line. Cost-based pricing formula provide, this is important, an initial approximation of the selling price. To decide the selling price, cost is an initial approximation. That is the minimum price, right? Cost, at least you need to cover the cost. Above that, okay, above that you have added markups and deciding the selling price, but cost is the minimum you need to cover the cost. That is the meaning of initial approximation. Initial approximation is the cost. Beyond that you can go, right? And then target selling price calculated on cost information can be adjusted based on future capacity available, maybe the competition in the market, or the management's general knowledge of the market. So you can always adjust setting target selling prices you have calculated based on cost. But when the cost is changing, you can always adjust the selling prices. So these are different points to be elaborated under cost plus pricing. And now, why the reasons for using cost plus pricing? Why are we using this cost plus pricing? There are few reasons. May encourage price stability. It may encourage price stability. What do you mean by that? May help a firm to predict the prices of other firms. Now, if in the market all the firms are using cost plus pricing, then you will be able to predict the prices of other firms in the market. For an example, if a firm has been operating in an industry where average markups have been 40% in the past, in your market, average markup is 40%. You know that. It may be possible to predict that competitors will be adding a 40% markup to their cost. So all firms will do the same in the industry. If all the firms in an industry price their products in this way, it may encourage price stability because all firms are adding somewhere around 40% markup. Cost will, there won't be big differences in the cost as well. So almost all the prices they have decided are stable. We can have price stability using cost plus pricing because they have not considered other factors to prices, right? They have considered only the cost. If the cost is the same, prices would be the same. If other factors are also coming, then there will be differences. But here, cost plus pricing, it takes about price stability. Simplicity. It's simple, right? Now you know how to decide the price based on cost plus pricing. Basically, you take the cost, whatever the cost you can take, you add a suitable profit markup, and then you decide the selling price. Difficulty in applying sophisticated procedures where a firm markets hundreds of products and services. Maybe you can easily take the cost of the product, or it is very sophisticated if you have so many products. You have so many products, individually you need to think about other factors affecting the price. But if you can take the cost plus pricing, then it is easy. Anyway, you know the cost, you can add a markup and decide the selling price. Use as a guide to setting the price, but other factors are also taken into account. As I told you, cost is the initial approximation. Cost plus pricing is the initial approximation, the minimum price you can charge. Above that, you can go based on the other factors. So it is used as a guide. That is the basis. Right. What are the limitations? Say, similar to reasons, good things, bad sides are also there. What are the limitations of this cost plus pricing? What are the issues, problems? First thing, it ignores demand. It doesn't talk about demand. Now, when I have a product, if I can take the cost of that product, I can add a markup and decide the selling price, right? That is the cost plus pricing. Have I taken demand into account? No, actually. So the price is set by adding a markup to the cost, and this may bear no relationship to price demand relationship. Now we know, as students who have learned economics, there is price demand relationship. Miller illum sambandhayak thiyena. When the price is increasing, demand is decreasing. But have I considered demand into account when I decide in the selling price? No. Without thinking about the demand, I have set my prices based on the cost plus pricing. So that is one major limitation of cost plus pricing. For an example, a cost plus formula may suggest a price of 20 rupees for a product where the demand is 100 units. They are estimating the demand as 100 units. My price based on the cost plus pricing method is 20 rupees. Whereas at price of 25, the demand might be 80,000 units. That's true. No? When the price goes up, demand goes down. When the price is 20, demand is 100,000, you estimated. When the price is 25, demand is 80,000. Assuming that the variable cost for each unit sold is 15 rupees, the total contribution will be 500 at a selling price of 20. You can compute it. Compared with a total contribution of 800,000 at a selling price of 25. Therefore, cost plus pricing formula might lead to incorrect decisions. See, so in this scenario, it says how the decisions can go wrong when you are ignoring the demand, right? That can happen. Circular reasoning. The next limitation is circular reasoning. What do you mean by that? Volume estimates are required to estimate unit fixed cost and ultimately price. Now, I told you demand is ignored. We are not taking the demand into account when deciding the price based on cost plus pricing. But however, there is circular reasoning. Now, when I take the cost of a product, what are the elements coming? There are variable cost, no problem. There are fixed cost also there. So when I take the unit cost of the product, I need to take fixed cost as well. How can I take the fixed cost into the unit cost? Maybe I need to take the full fixed cost, that is the fixed cost. I need to take the number of units estimated. I will have to estimate the number of units and divide the fixed cost and take the unit fixed cost. If not, I can't decide the full cost of the product, right? Variable cost I can take directly, but unit fixed cost I will have to estimate the demand anyway. So again, even though you are ignoring the demand, you have to still estimate the volume. That is to estimate unit fixed cost. Without the estimated volume, you can't take unit fixed cost. Why? You need to divide the total fixed cost by the estimated volumes, right? That's why circular reasoning is happening. Again, you need to take estimated volumes as well. And ultimately, you can decide the price. So circular reasoning is another thing happening in cost plus pricing. And then pricing flow. What do you mean by pricing flow? It is often claimed that cost-based pricing formula serve as a pricing flow, shielding the seller from a loss. Now, I told you this cost plus pricing is the initial approximation for selling prices. That is the base actually. That is the minimum. That is the claim. එහෙම තමයි කිව්වේ. If sales demand falls below the activity level that was used to calculate the fixed cost per unit, right? The total sales revenue may be insufficient to cover the total fixed cost. Okay, this would be clear if we practically do this example, because previous example I didn't do the mathematical part because anyway I'll be doing it here. Now you will understand what I'm telling. Here, first of all, remember, we told cost plus pricing is the initial approximation. That is the minimum price. That's the claim we made. But there can be issues with this one as well. What is the problem? Consider a hypothetical situation where all the cost attributable to a product are fixed in the short term. Okay, now there are no variable cost in our product, no variable cost, all are fixed in this short term, and an amount is 1 million. Okay, our fixed cost. Our fixed cost is 1 million. Right. Okay. Now, assume that the cost per unit is 100 rupees derived from an estimated volume of 10,000 units. Even though we say demand is ignored in cost plus pricing, I told you still we will have to estimate our volume. Why? To divide the fixed cost, right? If we don't have any estimate of volume, how can we get the fixed cost into unit cost? We can't. That's why here also they have estimated the volume. So they have estimated the volume, estimated the volume. How many units? 10,000 units. Okay, 10,000 units. Then in that case, what is the cost per unit here? Cost per unit. There are only fixed cost in this example. So in other words, unit fixed cost. Unit fixed cost මේ තියෙන්නේ unit fixed cost එක. මේකේ variable cost නැහැනේ. ඒතොර unit fixed cost එක. You call it cost per unit. Cost per unit 100 rupees. The selling price is set at 130 rupees using the cost plus method and a markup of 30%. Okay. Now the markup is added. Markup is 30% means 30 rupees, right? 100 multiplied by 30%, 30 rupees. So you add the markup and then you have decided the price as how? Cost plus this markup, cost plus pricing, 130 rupees. This is our price. Okay. If the actual sales volume is 7,000 units, now you have decided the price. You have estimated some volume to get the unit fixed cost as well. You have anyway now decided the price, that is the cost plus pricing. I told you that is the initial approximation. Now, the actual sales volume, when you go into the market, now the actual sales volume is 7,000 units. Okay. Now the actual sales 7,000 units. Right. Now, what is the sales revenue? If the selling price is 130, if the actual sales quantity is 7,000, 7,000 multiplied by 130, you have 910 revenue compared with the total cost 1 million. Therefore, the product will incur a loss of 90,000 even though it is priced above full cost. Now, your sales revenue at the actual sales unit of 7,000, your sales revenue is 910,000, whereas you have a fixed cost of 1 million rupees. Here you have a loss, right? You have a loss. Your cost is greater than your revenue. 1 million minus 910, you have a 90,000 rupees loss. But see, our cost was 100 rupees. Our price was 130. So based on the cost plus pricing, we made the right decision. Our cost is 100, price is 130. Our price is way higher than the cost. That was the initial approximation we had. But even though we take like that, since we have ignored the demand and everything, we just estimated the volume, no? We ignored the demand. We just estimated the volume. So when it comes to reality, when you start selling the products, there can be losses like this. If the selling quantity, actual sales quantity is 7,000, we estimated 10,000 and decided the cost. But actual sales quantity is 7,000. So you have losses like that. So not every time this happens. There can be situations this happen. So that's why this limitation is happening. Even though we take it as a pricing flow, it's not right all the time. There can be issues like this. So remember, those are the issues. Okay. Now another concept coming under this, target costing. Now we have discussed cost plus pricing. We took the cost, you added markup, then you arrived at the selling price. Now a different concept but similar to cost price, target costing. Target costing. You are targeting the cost now. Now you don't know the cost. You know the cost, you are targeting the cost. Basically, target costing is the reverse of cost plus pricing. In cost plus pricing, what did you determine first? Your cost. You took the cost, you added a markup and decided the selling price. In target costing, you take the price first. You take the market price first. And then what happens? You have decided a markup. You deduct your decided markup from the selling price. Let's say you are taking a price in the market, maybe 150, and you have a markup decided in your company. So let's say I want 40 rupees from each product. That is the profit markup you want. So what is our target cost? Let's say this is the price, market price. In the market, 150 similar products are sold at 150 rupees. And your company needs 40 rupees markup. Then what is the target cost? If you reverse cost plus pricing, you deduct your markup from the price. You deduct your markup from the price. Then you have the target cost. If I want to sell my product at 150 rupees, not if I want to, I have to, because that is the market price. If I have to sell my product at 150 rupees, that is already decided, and I need 40 rupees as the markup, then what should be my cost? Then what should be my cost? My cost should be 110. I can't go beyond 110. Why? I can't change the markup. I can't change the market price as well. 150 rupees, I need to sell it 150. I need 40 rupees. Then target cost is 110 rupees. That is the approach we are taking here. So here, what are the stages? There are 4 stages when it comes to target costing. Step 1, determine the target price that customers will be prepared to pay for the product. This is this market price. You have to decide the market price. You first determine the target price, not the cost. You take the price first. After that, what happens? Deduct a target profit margin from the target price to determine the target cost. You can deduct your determined profit margin. In my case, it's rupees 40. I have decided it in rupees, so I deduct my 40 rupees. Then what is our target cost? Our cost should be 110. If my cost goes beyond that, that's a problem. So my target cost is 110 rupees. That is the second step. Third step, calculate the budgeted cost of the product. Now what happens? Now you know the target cost. If I have to sell my product at 150 and I need a profit markup of 40 rupees, at least my cost should be 110. Now you see your budgeted cost. Now you are actually producing the product. No? Now you have different things coming. You have to incur direct material cost, direct labor cost, maybe direct other cost, overhead cost, everything you have to consider. No? So you are budgeting, okay, what is my budgeted cost for my product? Your budgeted cost. Let's say your budgeted cost, if you take after taking all these direct material, labor, other cost, you have a cost of 120. Right? Your budgeted cost is 120 for your product. Now, is there a problem? Yes. If you want to sell at 150 and earn a 40 rupees markup, your cost should be 110. That is your target. But when you budget your production cost, you have 120 rupees. Then what is the problem? you will have to reduce your price. What is the price gap? That means the cost gap. What is the cost gap? Minus 10, right? You need 110, but you have 120 cost. So you will have to reduce your cost by 10 rupees. That is the way we are doing it. So calculate the budgeted cost of the product. That is step number 3. Last step, step 4. If the budgeted cost exceeds the target cost, our budgeted cost is exceeding the target cost, investigate ways of driving down the budgeted cost to the target cost. You need to find out ways to reduce the budgeted cost to the target cost. Maybe you can negotiate with your suppliers. Maybe you can negotiate with your laborers. You will have to cut down unnecessary overhead costs. Likewise, you have to drive down the cost. This is the opposite, reverse of cost plus pricing. Right. So you can try this activity. NCC company manufactures two brands of computers. Simple computer, that is SC, and complex computer, CC. A market research reveals that the similar products to that of CC, that is a simple computer, no, sorry, the complex computer, are sold at a market price of 350 rupees. Okay, similar products in the market, right? Similar product in the market to CC, market price is 350 rupees. Right, 350 rupees. That is the market price. NCC estimated the cost of producing a CC as 305 rupees. Okay, now when you are producing actually this CC, what is the estimated cost? That means your budgeted cost 305 rupees. 305 rupees. Okay. And the company wants a 15% target profit on sales revenue of CC. Okay. What is the desired target profit margin? 15%. If you sell 100, if the market price is 100, you need a markup of 15 rupees. Likewise, your profit margin is 15. Okay, so what are the steps? What is required first of all? Calculate the target cost per unit and identify the cost gap. Right, so we'll calculate the target cost by following the steps. What is the first step? Step 1, deciding the market price, but deciding the target price. That is 350. You know why? In the market, 350 price is there. Then you need to see the target profit margin and you need to take the target cost. Now, what is the target cost? If my selling price is 350 and I want a profit markup of 15%, then what is my target cost? What should be my target cost? I need to deduct my profit margin, 15% profit margin from 350. So this is a profit margin, right? So simply I can take, I need to deduct 15% means if I multiply 350% by 0.85, that is 85%, then I have the target cost, right? Then I have the target cost like this, 297,500. Now see, if my market price is 350, 15% profit margin is 350 multiplied by 15%. Then my profit margin is 52,500. When I deduct 52,500 from the selling price, you have your target cost 297,500. It's the same thing I did. So that is short form. If I just multiply 350% by 85%, that is after deducting my profit margin, I have the target cost. Okay. Now you can see the problem. My target cost is 297,500. But my budgeted cost, when I see the budgeted cost, it's 305%. Then what is the cost gap? What is the cost gap? Cost gap is 7,500. That means you need to reduce the price. Price means the cost. Cost should be reduced by 7,500. You have estimated, you have budgeted 305 rupees as the cost, but your target cost should be, if you want to sell at 350 rupees with a 15% markup, that is 297,500. That is the cost you can have. But now cost is higher than the target cost, then you need to find out ways to reduce the cost. So this is how you usually do it. So answer is given like this. Okay, 350 multiplied by 85%. Then this is the target cost, and you compare it with the best budgeted or the estimated cost. Then you have a cost gap like this. You need to reduce this cost, right? So there's a small video clip for this. You can, when we share the slides, you can watch this because it explains against the target costing, right? How to calculate, how to reduce the cost. So you can watch it and try to answer this question when you go through this lesson. Right. And the final part, one before the final part, introductory pricing policies. Now, when we are deciding the prices, now you have discussed cost plus pricing, target costing and everything. Introductory pricing policies. In organizations, there can be pricing policies, different policies. Now, there are different pricing policies for different situations, right? Now, we are talking about introductory. When you are introducing a new product to the market, what are the pricing policies available? Most famous pricing policies. There are two. Price skimming policy and penetration pricing policy. Price skimming and penetration pricing policy. What do you mean by price skimming policy? Price skimming policy is charging a high initial price to maximize short-term profitability by spending heavily on advertising and sales promotion to obtain sales when demand is not very sensitive to price changes. Now it's something like this. Let's say you are introducing a new product to the market. You have a very unique product characteristics as well. Now, at the introduction, you have marked a higher price, very high price, right? And you are doing more and more advertising and sales promotions as well. So at the beginning, you charge a very high price, but you are doing more and more promotions. And what is your price sensitivity? Your product's price sensitivity. When the demand is not very sensitive to price changes, there are no big effects coming from the prices to demand. Even though you have charged a higher price, that won't severely affect your demand as well. So it's a unique product. That's why. So you have a unique product. You are charging a higher price at the beginning, and you are doing more advertising and sales promotion to obtain sales. After that, once the market becomes saturated, that means after some time, in the beginning you charged a higher price. So after some time, the price can be reduced to attract that part of the market that has not yet been exploited. After some time, after establishing yourself, you may be reducing the price. Why? You can now increase your market share. Some people have not purchased it before because of the higher prices. Now they also can try this product. So initially you are charging a higher price. That means price skimming policy. Price skimming policy. Initially higher prices, and you are doing more promotions and say advertising. After that, after market becomes saturated, matured, you are decreasing the prices to exploit other market segments as well. That is price skimming. Last one, next one, the second one, penetration pricing policy. Penetration means initially you are charging a low price. Initially you are charging a low price. Why? You need to expand your market. You need to introduce the product to more and more customers. Policy of charging low prices initially to obtain sufficient penetration into the market. To go into the market very quickly at a low price, you are going for penetration pricing policy. අඩු price එකක් charge කරනවා මුලින්. එතකොට ගොඩාක් ඕගොල්ලන්ට spread කරගන්න පුළුවන්. So pricing policies, introductory pricing policies, there are two major: price skimming, charging a higher price, or penetration pricing, charging a lower price in the beginning. So those are the two different ways. So always pricing policies may vary depending on the different stages of a product's life cycle. That's why I told you these are introductory pricing policies. When introducing, sometimes there can be other pricing policies when you go along the product's life cycle. When you are in the maybe growth stage, maybe at the declining stage, maybe at the maturity stage, different things. So here also, even though you charge a higher price in the introduction, which is price skimming, when you are at the maturity stage, you are decreasing the price. So that is a policy, right? So you have different pricing policies based on the product's life cycle. These are introductory pricing policies, right? The last one, pricing reviews. That is important. When you decide the price of your product after considering so many things, cost and other factors and everything, you need to review your prices regularly. If not, what will happen? Initially, when you are deciding the pricing, some factors were there: inflation rate, interest, competition, competitors' prices, organizational factors, cost was there. Based on those factors, you decided the price. But after some time, after 1 year or 2 years, those factors have changed. Now the competition is different. Many other competitors are coming. Technology has changed. Raw material prices have been changed. Our cost has gone up. Now because of that reason, you can't have the same price for years, right? Definitely you need to review your prices. Once a selling price has been established, it should be reviewed at regular intervals and new prices should be arrived. That's why product prices are changing, right? If you have purchased a soap previously at 30 rupees, now you can't because of market conditions, COVID, any other distribution issues and everything. Now the prices are very high. So a few factors to be considered under pricing reviews. Now you need to comparison of actual sales with the previous year's sales and budgeted sales. You need to see whether your price is too much in the market. Maybe you have decided the price, but you need to review it, whether my price is very suitable into the market. If your demand has dropped significantly compared to last year, that means your prices are little too high compared to other competitors. That's why customers are not purchasing your product. Maybe you need to reduce the price. So that's why price reviews are important. Market share in individual markets. If you have a good market share or if you have a low market share, if you want to expand your market, maybe you will have to change your prices again. Price complaints. If there are so many complaints saying this is very expensive, there's no value for money, likewise, if there are complaints, you will have to consider them. Why? Actually, my price is low or high. And then competitor prices. Obviously, you need to see what are the competitor prices. If the competitor has reduced the prices, then we also have to reduce the prices because competitors' prices are lower. Likewise, you have to review your prices. So once decided, it's not fixed. You have to review the prices on regular intervals based on different factors. Right. So with that, we have come to the end of this lesson. We have discussed different factors affecting the prices, and then we discussed economist pricing model. What are the limitations? Because of that limitations, we are talking about prices in management accounting aspect. And what do you mean by cost plus pricing? You learn different approaches for cost plus pricing. All are mathematical and based on the traceability of cost, right? And then you discussed the limitations, reasons of cost plus pricing, and the target costing. We did one question as well, target costing. You decide the selling price first and then your markup and then you target the cost. After that, you can compare it with your budgeted cost and find out ways to reduce the cost, target costing. And then you discussed different introductory pricing policies, market skimming and penetration, price skimming, price penetration. Those are the introductory pricing policies. Finally, why are we reviewing the prices? What is the reason for price reviews? So those are the things we discussed in this lesson. Right, so I hope you are clear with the content, but if you have any clarifications, you can reach out to me. You can get yourselves clarified, and please watch that video. That is very useful. All the things in target costing, it is discussed. So I hope you will watch it as well. Right, okay. So thank you for listening. Goodbye and see you again.